Income investors have been forced into an uncomfortable position. Either accept the negligible amount of yield on safer bonds or take significantly more risk, often with junk bonds, to generate the income they need. To add insult to injury, governments around the world are printing money at unprecedented rates, and this spike in money supply is very likely to lead to inflation. One startling fact: 23.6% of all US dollars in existence were created in 2020. So what is an income investor to do when inflation is knocking at the door and yet interest rates remain continually suppressed? As the saying goes, follow the smart money. A 2021 KKR survey showed that a large number of chief investment officers are now using private credit as an alternative to traditional fixed income. Over many years, banks have become increasingly handcuffed by regulatory restrictions in the type of loans they can make. Enter private credit. Private credit, or private lending, is now a $1 trillion asset class and represents a large and growing percentage of loans made to corporate borrowers. These loans are for a variety of different uses, covering everything from real estate to specialty finance to traditional senior secured debt. Private credit lenders have less constraints and far greater flexibility than banks to creatively lend capital, and in doing so, they demand higher returns. In fact, private credit yields are currently generating between 7% and 10% annually without leverage. The natural question follows: just how has private credit performed during rough economic seasons? Between 1992 and 2008, a period that included the dot-com crash and the Great Recession, private credit still returned over 5% annually for its worst 5-year period. Quite the showing compared to other asset classes. To paint a clear picture, one must understand the trade-offs. While traditional bonds have daily liquidity, private credit managers require investors to be locked up for various periods of time depending on the investment vehicle. While the income is typically paid quarterly, one may have to settle for less liquidity in order to generate the desired cash flow. The selection of the private credit manager is also crucial. Ultimately, the success of the loan portfolio is determined by the underwriter, so selecting a reputable manager with deep pockets, robust experience, and low default rates is also key. And finally, like most private markets, purchasing power is key in order to extract the best possible terms for investors. Over the past 20 years, CAZ Investments has used the collective purchasing power of our nearly 2,000 investors worldwide to demand exclusive access to unique opportunities. CAZ has strategic partnerships with many of the nation's top private credit managers, which affords investors superior terms and economics. Our shareholders' personal capital is always invested alongside our clients. Visit us at CAZinvestments.com and schedule a call with a team member today.